Hi, thanks for joining the NAB Federal Budget 2021 digital event. I'm Nasim Kadem, and today I'm talking to a range of NAB and industry experts on what the budget means for your business and the economy, how it can help you move forward and make the most of your ideas. You'll be hearing from NAB Executive Business Metro, Michael Sardi, PwC Partner and Tax Specialist Paul Abbey, JB Ware Chief Economist Sally Auld, and NAB's Group Chief Economist Alan Oster. We'll commence our discussion with a budget breakdown from Alan Oster before we then move to our panel discussion where we can unpack the key issues. A little later on, you'll be given the opportunity to ask any questions you might have, and you'll be able to submit questions via the question box located on the right of your screen. But first, I'd like to acknowledge the traditional owners on the land on which we meet today. I would also like to pay my respects to elders past, present and future. Australia's economic recovery continues at a brisk pace. Forward-looking high-frequency indicators point to ongoing strength in activity in the labour market, even as some fiscal support is wound back. Business conditions and confidence are at record levels, SMEs being the standout. Australians' iron ore prices are now close to the highest they've ever been, and this and a return to higher levels of employment has boosted Treasury coffers. The federal government's made it clear it wants to spend big. But where? There are business sectors that continue to need direct support from the government, for example, the arts, education and tourism. But for many, the focus is on growth. They're looking for key measures that will help them make the most of current opportunities. Now, I'd like to welcome this LinkedIn live stream audience that's just joined us. You're about to be hearing from Alan Oster, NAB Group Chief Economist, and he's going to give us a budget breakdown, sharing his expert insights into the state of Australia's economy and how businesses stand to benefit from the government's measures announced last night. Thanks so much for joining us, Alan.
And welcome everyone. What I'm going to do now is take you through a slide pack, about 20 minutes, try and give an understanding of what's actually happening. As you can see on the slide there, some of the themes I'm going to be talking about is very much about the amount of spending that we're having, and then also that this is a budget that is not about fiscal repair. And the other thing I'd sort of say at the start, remember we've got an election within 12 months, so we probably haven't seen the last of fiscal policy. I should also say this presentation and our more detailed commentary are available on our website if people want to access it. Okay, so I'm going to start off then by sort of an overview. And I suppose the first thing I'd say is whilst there's a lot of spending, there was some withdrawal of fiscal stimulus, JobKeeper, etc. And the way I sort of summarise it, in the last two budgets, what the government actually did in terms of boosting the economy was worth about 8% of GDP, and they've taken back about 2% in this one. So you're still very, very stimulatory. What we're looking at there is some of the big issues, and I'll talk a little bit more detail about where they're spending the money. We've also got a situation where, to be honest, the economy is so much better than we thought it was going to be. The vaccine's better. We've got most of the jobs we lost. We've got all the jobs we lost last year back. And when we look at the forecasts overall, they're very similar to what I've actually got before going in. So, you know, we're all going to have to be humble after our forecast last year. But to me, these sort of forecasts look reasonably credible. There were one or two things that are sort of surprising to me. One of them was the idea that the iron ore price that's $220 is going to end up at $50 next year. So that's quite conservative. And the other thing that I think was interesting was that the investment outlook, according to the official data, was actually quite weak. And I think that's really important. So what I'm going to do now, in terms of just run through a few of the big picture spending areas, and again, a lot more detail on the website. But in terms of where did the government spend its money, I suppose, is basically, so you start off with the aged care package, roughly $18 billion. So none of these are small stuff. Infrastructure, they've already got a pipeline of 100 billion. Now they've got a pipeline of 115 billion. So another 15 billion spending, mainly roads, rail, and that sort of stuff. The focus on childcare, trying to basically make childcare cheaper. About 1.7 billion on that. Fully funding the NDIS, that was about 13 billion. And the idea of trying to help housing by making empty nesters or encouraging empty nesters that they sell and they can put their money into superannuation as long as they've had their house for 10 years. In terms of some of the other things, there was essentially specific money for some parts of the economy. So areas such as agriculture, medical manufacturing, and areas that essentially the economy is still doing tough in terms of things such as tourism, hospitality. What's not there? I thought that they might be doing more on productivity. So there was nothing there about personal income tax bringing forward, or company tax, although what the government did do was they said, well, the low and middle income asset offset, which is worth about $1,080 per year, is extended for another 12 months. And they've also extended for another 12 months the instant asset write-off as well. There was very little in terms of what economists call microeconomic reform, cutting red tape and that sort of effects. And as I said, we haven't yet really seen what they're going to do for the election, but I guarantee you there'll be more money there. Okay, just in terms of the shape of what is happening, in the slide that we're looking at there, we're looking at what you might call jaws. In other words, what's revenue and what's income coming in. And what you can see there is all run on the expenses. On the right-hand side, if you're looking at that slide, that's a really interesting slide to me. So the grey bars there on the bottom are essentially what the government has done on policy. And the black line at the top is what the better economy has actually given them. So and the red line is where you've ended up. And what you see is, for example, next year, essentially what the government got by the better economy, they're completely spent. And as you go further out, you can see the black lines are okay, but the grey lines, i.e. the policy, they just kept spending it. Another way I can look at it is, this is a complicated slide, but what you see is the red bars are the fiscal stimulus. And basically, in the last 2 years, around 4% of GDP each year was spent. And then you come to this year and there's sort of like 2% going back the other way. And if you look at the black line, that is where your structural surplus is, and it's still 5% away at the end of 23 from a surplus. So it's saying that you're not going to get a surplus probably this decade, is sort of the bottom line. Okay. How do the budget forecasts compare to ours? This is just a slide that looks at the world. And broadly, I'd say, sure, there can be differences around there, but our global forecasts are very similar to what the government's assuming. So again, what you see is a big recovery globally in the world economy after a terrible year last year. So, you know, we're talking about 6% growth, which is really unusual, and then round about 4%, and then by the time we get out to 23, maybe something like trend growth again. Really important to understand where the economy was before we started. So these are just a couple of slides on what happened to the core parts of our business survey, which we published on Monday, so it's about a week old. And what that graph there is showing you, all the key measures, they all collapsed last year. Now, business conditions, business confidence, forward orders, they're all at record highs. So there are readings that we haven't seen. This monthly survey has been going since 1996. We've got a quarterly version that goes back to 89, and they're all record levels. Where is the survey saying things are strong? Well, basically, just about everywhere. Retail is strong, mining is strong, general services is strong, and when you look on the right-hand side of that chart, what you see is it's basically everywhere. Western Australia is probably leading, New South Wales is now second, and Victoria's sort of caught up. So that there's sort of some very, very strong momentum in the economy as we enter this budget, which, as I said, spends a lot of money. This is an interesting slide. What NAB tries to do is we look at every consumer who banks with us, and we look at the cash coming in and the cash going out. And it goes back to the GFC, where there's some wiggly lines around, but generally the trend was, for the last few years where I've circled that, before you got to the pandemic, essentially households' balance sheets, there was less money coming in than they were spending, or it was deteriorating. Then you can see that spike. So what happened is, there's the government. Here comes the government, and you sort of get about 4 years back. What's interesting now, however, is come early this year, what we're seeing is you're back to sort of same amount of money coming in, same amount of money going out. And that just makes people feel a bit nervous. And in our business survey, one of the interesting things was, whilst retail is really strong, retail confidence is the worst of any part of the economy. So there's some concern about, you know, how strong consumption will be as we go forward. Okay, now I'm just making a few comments about where's the numbers. Our forecasts and their forecasts essentially the same. So we have 1% this year, or this financial year. They've got 1.2. We've both got 4.25 for next year, and essentially we've got something very similar, around 2.5 for the year after that. So a big picture story is, they might as well use our forecast, or we should use theirs. There were, however, some surprising differences. I've already mentioned this thing about business investment. So instant asset write-off, you would expect that business investment is going to help drive the economy. Their growth forecast is essentially no growth in business investment next financial year. The difference, where do we get it? They have more in consumption. They also have a better, essentially, net exports. In other words, exports versus imports. On the outlook, Treasury's a little bit more conservative than us, so we think unemployment by the end of 23 might be down to about 4.25. They don't have unemployment around 5 until the end of next year, and then they end up at about 4.5. So they're being a little bit conservative. Inflation, wages, not a lot of difference. And they're, in fact, if anything, a little bit higher on inflation and a little bit lower on wages. But the bottom line would be, both set of forecasts are consistent with no increase in interest rates for quite a while. In fact, till 2024. And nothing will have changed in the result of this budget. So here's a sort of summary version, what our forecasts are and what their forecasts are, and you can see no difference. What I wanted to do is also share a little bit of some of the data that NAB collects internally. And so what we're doing here is we're looking at every electronic transaction that goes across our systems weekly. We used to compare it to the same week last year. We can't do that anymore because of what happened last year. So what this chart's showing you is, where were you in consumption and retail at the beginning of the year, and the dotted lines was the pattern that occurred during 2019. So what we're sort of seeing is that, if anything, in the first few months of this year, retail and hospitality were not that great. They're caught up a bit now, but you know, it's not shooting the lights out. And some of the retail sales numbers in real terms in the first quarter this year were quite weak. In terms of by state, you see lots of volatility. I've circled on there what's happened this year from the beginning of the year, and it does look like it's an upward trend now, whereas in 2019 it was much less. The other thing that we look at a lot is every business that banks with NAB, we can see their cash flow in and out from a revenue point of view. And again, what I'm trying to do here is business revenue coming in vis-a-vis what happened in 2019. And what you can see there is the revenues coming in at the same rate, and if anything at present is actually accelerating. So it's saying underneath it all, it's and small businesses leading the way, that these things are doing pretty well in terms of revenue. A lot of slides here, but basically what I'm trying to show is some of the areas where you've got strength. So if you're looking at that, you've got construction, you can see manufacturing is quite strong, you can also see agriculture very strong, and wholesale is not bad. Retail is now roughly where it was in 2019, although in the top graph there you can see the impact of an early Easter came in quicker. There are some sectors that are still terrible, and the bottom one is is education. And what you see is you normally get that big spike when all the foreign students turn up. They didn't turn up. And so that's why you want to do and look at parts of the economy and try and keep the support going, which the government tried to do. This is just an overall chart to try and give people a perspective on what happened. So the blue line is private demand and the red line is public demand. And what you're basically seeing there, and that graph goes back to the 80s, what you're seeing is the sort of fall that we never saw before, and it was held up by huge amounts of public investment. And now we're sort of moved into the overview section that says private sector demand's really come back, but at some stage, unless you get a lot of business investment, it's going to peter out a bit. Okay, final couple of slides for our outlook. Red is the quarterly GDP numbers, and the black line there is essentially the 12 months too. So again, what you're seeing is massive spike down, massive spike back up, and growth then starting to come back towards trend. And then my final slide is basically trying to give us a feel for what happened to employment. Employment is basically the red, and you can see this time last year these massive falls in employment. Now you're seeing these massive spikes back up in employment. So the unemployment rate, as I said, we're expecting it to be below or around about 4.25 by the end of 2023. So if I'm going to summarise, my summary would be something along the lines, the government spent a lot of money. They've basically gone into a situation where they're keeping the economy going. I would have preferred to see a little bit more in terms of reform and try and make productivity better. But, I think we'd certainly trade this outcome to what we thought we were going to see this time last year. Thanks.
Thanks again, Alan. It's now time to farewell our LinkedIn live streamers. It's been great to have you with us this morning. If you want more on NAB's budget breakdown, visit our federal budget hub at nab.com.au/federal budget. For those of you who are staying with us, you'll be hearing now from our panel of experts. We have the opportunity to discuss with them some of the key highlights of last night's budget and what it might mean for business and the economy. A little later on, they'll be taking questions from you, so you'll have all the answers you need to make sense of the 2021 federal budget and know the way forward. Well, we've just heard that many Australian businesses are back on track, particularly our small and medium businesses. They'll be looking to build on the opportunities out there right now. I'll start with you first, Michael. What will the government's latest measures mean for them? And is there anything in there to help them invest further growth?
Yeah, thanks, Nassim. I think you picked up from Alan's presentation around where we'd been in the last 12 months, and the start of the year was pretty the pandemic was quite horrific in terms of the implications on employment, retail sales, everything else. But what we saw in the last 12 months was a great deal of stimulus that was provided by the government that actually supported the bounce back that you could see in a lot of the graphs that Alan talked about. My call would be that this budget that was announced last night is about the maintaining of the momentum that has been built up in this economy. And when I look at the initiatives that have been brought down in last night's budget, a lot of that will continue to support businesses in Australia. A couple of key things when you think about an additional $15 billion for infrastructure, in addition to the $100 billion, businesses benefit from that. You could only imagine the number of suppliers or services that are required to deliver on that infrastructure. $18 billion for aged care, a similar sort of thing. The capital benefits in terms of the immediate write-off, meaning that our customers and businesses in Australia can continue to build efficiencies by upgrading equipment, plant, and doing things differently and being able to receive the appropriate tax benefits. So all the way through, when you sort of see everything that was announced last night, I could certainly put a tick to each of them to say that will continue to support business. So my summary would be continued momentum, continued support for businesses in Australia that will drive further employment and achieve some of the forecasts that we've talked about.
Alan, in your presentation, you did mention that there hasn't been much in this budget for productivity, for boosting productivity. Is there anything at all that you could point to that does?
The short answer, to be brutally honest, is there's not a lot there. It's more about, let's just, as Michael was saying, just keep it going. I think what is really important is that we try in the medium term to get business investment taking off some of the load from consumption. And there you need to get people sufficiently willing that they can actually invest. So the instant asset write-off helps. But, cutting red tape, trying to make things work better is really important, because I should say that I'm actually quite optimistic in the medium term. Australia's handled the virus really well. We haven't had the damage that all these other countries have had. If we can just get our economy humming a little bit more efficiently, in 2 to 3 years' time, people are going to look at Australia and say, that's a great place to live, great place to invest and to employ. And if we can do anything just to make, essentially, grease the wheels a little bit, that would be really beneficial. I still think the outcome is going to be good, but I would have liked to see a little bit more on the productivity enhancing outcomes.
There's probably in the budget, Nassim, there's a couple of really little things along the lines of what Alan's talking about. There's a proposal that the ATO develops a concierge service in regard to investment in Australia, which I think is a bit of a reaction to some of the difficulty foreign investors have had through the FIRB process and maybe some of the tax impacts in the FIRB process. And there's also, within the tax changes, there's one or two small things to encourage foreign investment. There's a move to a collective investment vehicle based upon a corporate for the funds management industry. There's a move to make residency simpler for people who are coming to Australia to determine whether they're a tax resident here, and that's in part sort of focused on attracting technology-based employees to think about coming to Australia. And there's a little bit around technology investment, and in particular in biotech and medical, with the proposition that we would develop a patent box, which is similar to what other places have, for instance, the United Kingdom, which allows, in essence, the income from certain pieces of IP to be taxed at 17% rather than at the normal 30% rate. So there's a few things there to stimulate a bit of investment, but as Alan says, it's not a massive change. And the one particular thing that, as Michael points out, is that they've extended by 1 year the instant asset write-off. But as the budget numbers say, a lot of that is really timing. It's just bringing spending forward. And in fact, the forward estimates say that the impact of it will roll out. So it's not a substantial long-term change.
In last year's budget, there was actually a lot of incentives to encourage businesses to hire new staff. Has it included any additional incentives this time around? Maybe we start with you, Alan, and whoever wants to pick up.
I think my short answer to that again is not a lot. They haven't stopped them, but I think it's more that they just kept existing things going, and here's some more money, particularly in areas that I think the government essentially feels under pressure politically. So they're, childcare, women's budget, etc., etc. All those things are good, but is it fundamentally encouraging people to employ a lot more? Well, yes, you get the economy going, and will keep going, but you can't keep doing that forever. Ultimately, we look at long-term growth and we think productivity, participation rate, population growth. And yes, we'll get some, people come back, but unless you start looking at productivity, then that's going to eventually fade away.
So it sounds like it does have this spending to stimulate the economy through big spending. This has a shelf life.
Yeah. Well, if you keep going forever, people will start. Now, the good thing about Australia is even at the peak level of debt, we're 40%, or likely to be around 40% of GDP. The world started before the pandemic at 90. And so, if anyone can do it, we can do it. But you would like to say that at some stage, well, let's try and get something that's more self-sustaining, I think is the bottom line.
Well, what's interesting is I think the numbers in 2032 will be at 37%, but then when you look over the forward estimates for what the debt will cost us, there's no year where it costs more than 1% of GDP.
Yeah, that's right.
So it's cheap debt.
Yeah, and that's another really good, it's basically, a government bond, around 2%, so it's less than inflation. So it's a great time if you're going to do something, then now's the time to do it. But I prefer to be productivity enhancing rather than just here's some cash, guys.
I think the only other thing I would say, Alan, is that that productivity piece is also been driven, but in small business and businesses, and so it hasn't been at an overall infrastructure perspective. What we've noticed is, as we're engaging with our customers, when the pandemic hit, most customers looked at their business operations line by line and absolutely cleaned out what they didn't need to do, and then they looked at how better that they could do things. And I think that's actually put the economy in good stead, because most of our customers are actually in the best position that they've ever been in. So I think that gives us a great foundation to continue to build off.
Yep.
The country's CBD areas have been particularly hit hard by the pandemic. So to what extent does the budget sort of provide, support and opportunities for them?
From my perspective, if you have a look at most CBDs, they have been unbelievably impacted by a lot of the longer lockdowns and shutdowns that we've had. We're noticing that Perth has actually bounced back quicker than any other CBD. Sydney's a lot better. Melbourne has still got some major issues, and what this budget does is hopefully some of the investment incentives allow for, where there's vacant shops, an ability for customers or people to have a look at what opportunities do they absolutely present. But the other dynamic that you need for that to be successful in the CBDs is major corporates. How do they actually get their people back into the offices? That is the key component to sustaining these Melbourne CBDs. So if the investment allowances and some of the incentives that have been put on the table through the budget promote that, and we have the dynamic of corporates coming back and we get more people back in the CBDs, over the next 2 or 3 years you can certainly feel that they'll be bouncing back. But I think we've got a way to go.
And the professional services sector is also looking much better than it did 12 months ago.
Yeah, exactly.
Is there anything specifically in there for them?
Look, I think when you look at some of the changes and what actually happened in the last 12 months, the professional services sector, benefited from a lot of the advice that they actually had to put in place in terms of JobKeeper, JobSeeker, a lot of the the capital, the instant write-offs. So accountants did quite well. Then you had the property market bouncing back pretty well. So you had real estate agents doing extremely well. A lot of legal people getting involved in terms of some of the advice and structuring that went on and the clean-up that I described. So That I could certainly see continuing, even to the degree when you think about some of the changes in terms of superannuation. So wealth managers and such will be talking to their customers about how best they can apply some of the changes in that budget.
And what you're actually seeing in that market is now capacity constraint. And
Yeah.
the biggest problem in professional services is now people, or an absence of people, and
Correct.
in particular foreign secondees
Yeah.
and people being able to come into the country.
Yeah.
Is a problem because people left early pandemic, haven't been replaced, and replacing them right now is not viable.
Yep.
So across legal and accounting and other professional
Yep.
services, you're now seeing
Yep.
a problem in recruiting, and you're now seeing firms offer 1 week bonuses and
Yep.
stimulatory actions and bigger
Yep.
end of financial year bonuses than what they have been doing before, because they're very concerned about actually holding workforce.
No, very much so. But that whole, I think, war for talent piece is starting to eventuate in most industries. And so what we're sort of seeing, a direct outcome of the stimulation of this economy so quickly in the last 12 months is actually leading to fairly much a drain on talent. And so people, if there's one thing that I pick up in most conversations with our customers, is being able to retain and find good quality people.
But we're constantly hearing that people aren't getting pay rises anymore. So how does this spread across the economy? Is it just the professional services? Is it just a small sector, or will this eventually spread to other areas?
Well, it's interesting. Treasury's forecast for wages are even lower than ours.
Yeah.
And I think what you're seeing at present is shortages in some areas. So in the skilled areas, you're seeing it in agriculture, you're seeing it in mining, and you're also seeing it in construction. But are you seeing it across the entire economy? I think it will pick up. But one way to think about it is the Reserve Bank is targeting 2.5 for inflation. To get that, they need 3.5 roughly for wages, because productivity is roughly 1. So can I see 3.5 for wages anytime soon? That's why the Reserve Bank says we're going to stick around until 2024. Once they finally get that, I think they'll go quite aggressively. So maybe you'll see 2% increase in rates within a 12-month period, but you're talking 24, 25. So I think the wages issue at present is in selected areas. And whether it'll stay there, I don't know. But what we all hope is if you keep the economy going fast, eventually you will get this generalised shortage. That will then help. Helps the economy spend, it helps people have more income, and away you go from there.
Sally, the market's been surprisingly robust over the past 9 months. How will this budget help the market in the medium term?
Yeah, that's right. I mean, I think markets have been very robust, as you say, and that's partly a function of pricing in a better economic outlook and an environment where, as Alan was just talking about, interest rates are going to remain low for a number of years. I think in the short term, the budget does really sort of reinforce that view. So the tax offset for low and middle income earners, that's growth positive. The instant asset write-off, that's short-term growth positive. So all these things really reinforce the message that the economic fundamentals short-term are very strong, and that should, all else equal, be a pretty supportive environment for growth assets like equities and the like. Looking out into the longer term, to me, I think the question you have to answer is there enough in the budget that makes us confident that we think that the long run sort of rate of trend growth in the economy is now structurally higher, and that might be because we've done a lot to enhance productivity or labour supply. As Alan talked about, I think the answer to that is probably not enough. And that's really once we move beyond this idea that the budget is there to support the economy, over the short term, the question is, what does it do for the longer term? And does it really deliver on this idea that by fostering growth, you can almost grow your way out of the deficit? And I think we can sort of do that in the short term, and we saw from the parameter variations in the budget that trick has worked. But the question is there enough that will help us grow out of this over the longer term? And I think, the short answer is probably not. But notwithstanding all of that, I think what's in the budget is definitely supportive for equity markets in the short term. Let's also remember that we've got a pretty unusual or a pretty rare set of circumstances at the moment where, for the first time in a long time, both fiscal policy and monetary policy are pushing in the same direction. They both have the same objective, which is to get the labour market to full employment as soon as possible. So that, all else equal, is a pretty supportive environment for the domestic economy. And I think that's great in the short term, but then we need to really think about how do we sustain that over the longer term.
So do you see any new investment opportunities arising from this year's budget?
Not as much as we would have liked to have seen, and I sort of feel like, when we look at I guess the makeup of the Australian economy, one thing that sort of has been missing in action for the last 5 years has been business investment, and we've sort of discussed this morning that we don't think there's a lot in the budget that's going to sort of put a rocket under that area. There were little bits and pieces here and there in the budget, but yeah, nothing that really sort of strikes us as sort of opening the doors really wide for sort of new flows of capital into different areas. A little bit at the margin, easier for sort of people with skills in tech to come. Some small sort of expenditure around gas generators and hydrogen, but they're all pretty marginal in the scheme of things.
Paul, the government's instant asset write-off was a huge hit with businesses last year, and now that's been extended. Is it going to be the same big hit?
There'll still be an enormous advantage. It's a very clever policy, because one of the things it says that you have to do is you have to have the capital built and ready to be operated by, it used to be 30 June 22, now 30 June 23. So it's a great deadline focus, because it means that you've got to actually plan to spend, get the equipment built and get it ready for use. And all of that's got to be done by the deadline. You just can't kind of sign some contracts and commit and hope to fall in the future within the relief. And so that gives you this enormous stimulatory impact, and it's done that for businesses with a turnover under $5 billion. And then they extended the tests to bring more people into the process halfway through last year in terms of developing it. So it's done, as Michael says, it's done a lot. A lot of it is timing. So a lot of it, and the budget, as I said before, the budget recognises that it's bringing stuff forward rather than changing the fundamental structure of what's being done. There is one small additional thing in the budget which goes to the tech focus, which is also that they've introduced a new way of approaching the regime for write-offs of intellectual property, so copyrights and patents and things like that. They're going to allow, in essence, a self-assessed process to working out how fast you should write off that spending. So that does encourage a bit more of a long-term structural change, possibly. But it's been a very good immediate stimulatory measure, and associated with the loss carryback idea, which has also been extended for another year, whereby if you've paid tax anytime from 18-19 forwards, you can use current year losses to carry back to refund that tax, which again is a timing measure, but it means that you can spend a lot of money now, get an instant write-off now, get a tax loss now, take some of your prior tax payments and get them refunded to you, so fund part of that spending, and it's a blip. It's giving us a big blip just at this moment, and we'll unwind from it, but the blip has been very effective in the short term.
And Paul, just an extension of that is, as they're where we are upgrading equipment or putting new plant in, and that it does provide a great deal of more efficiency and effectiveness. That then our customers are then looking at, well, we've been able to do this a lot more effectively, and so where can we actually redistribute that previous cost, and then investing on the side of it. So we're seeing the benefits come through. An example of this was a recycling plant that I went to, and they've actually got their throughput now 3 times quicker than they had previously on the back of new equipment. So that means that they can invest differently.
Yeah, that might give Alan some productivity growth.
There you go. Exactly. Yep.
And Paul, you mentioned some of the other tax incentives around foreign investment, but the big thing that the government's long been talking about is tax cuts. Maybe take us through some of those changes and whether you think it's going to help people get out and spend.
Well, on the tax cut front, it's not in the budget, and in fact it's not even discussed, but the interesting international dynamic is what's happening with corporate rates, where you've had both in the United States and in the United Kingdom a discussion of moving the corporate rate back up, We are right now at the top of the OECD. We're at 30%, and we've been at 30% for a long time. And when we got to 30%, we were right down the bottom of the OECD league table in terms of where corporate rates were at. Now we're sitting much more right near the top, but it might be that people are starting to move back to us. So that's the big issue not addressed in the budget. We're going to have a system of a 25% rate for small business, a 30% corporate rate for big business. We're going to move soon to a position where 95% of the population will also have a personal rate of 30%. So you might see that particular change, the impetus for that change might be lost now to actually bring that corporate rate down. And then in the budget, in terms of encouragement to spend, the things which I've mentioned this morning are interesting and in the tech sector particular, but there's not a huge amount of stuff in terms of tax change and encouragement across the scheme. There's the patent box, as I mentioned, for tech. There's a gaming offset, but it's a very small thing. Again, in tech, there's a focus on employee share schemes, which in particular in VC and startup and tech is an important thing to have improvement in employee share schemes. There's a review by the Board of Tax of the R&D incentive, which we've had a generous R&D incentive, then we've cut it away, and now we're looking at it again in terms of what to do in regard to R&D. So there's a few things there in the technology area, but overall there's not an enormous amount right now, and I think that's consistent with what Alan was saying, that a lot of the stimulatory action is really on the spending side rather than on the revenue side.
Okay, well, I think we'll leave our discussion there so we have some time for questions from the audience. If you haven't done so already, please submit any questions that you have using the question box, which is located on the right-hand side of your screen. And in the meantime, we're going to have a very short ad break.
You have a business mind. You have an ability to see ideas others don't. Opportunities hiding in plain sight. It's why you're in business. And at NAB, we want to help you make ideas more. NAB, more than money.
So now questions are going to be submitted and we'll be able to direct them to the relevant presenters. Right, so our first question is, doesn't infrastructure spending help with productivity gains once completed?
Short answer to that is yes. We would hope. In other words, what you've got to do is you've got to try and take politics out of where they're spending. But in general, if you get better infrastructure, so better roads, better rail, that will help. But it will take a long time to come through. The problem with some of these infrastructure packages is that they always take 4 to 5 years or longer. I always remember back when I was in Treasury in the early 90s, there was a big infrastructure spend in the 92 sort of budget. It actually hit the books in 95 when the actual spend occurred. So, yes, it does, but there are other ways, more direct ways, where you can get a better bang for your buck, if you like, on productivity.
Don't we often run into capacity constraints in infrastructure spend?
Yeah. So, you know, at one stage, a couple of years ago, they said they'd run out of cement in Sydney.
Grattan always, in their infrastructure reports, always say it's not about spending more, it's actually using what we've currently got more efficiently, and we get more out of doing that. It just doesn't sound so attractive as a policy proposition.
No,
yes.
Yeah, and you know, you see the sort of short-term blockages that you get, and I mean, the one I quote all the time now is cost of a brick in Sydney last year, 30 cents. Today, you can't buy them under $4. And that causes you grief.
So we have another tax question. What are the thresholds for preferential tax treatment for employee share ownership plans?
I don't think that was covered in the budget last night, Nassim. Maybe firstly what they did in the budget, which is that with employee share plans, one of the issues is you get given your employee shares or your rights, and the question is, when do you get taxed? And of course, you're being taxed on the value, not getting any cash at that point in time. So you want that taxing point to be as long as possible away to try and allow you to hold the shares while value grows and you're not having a tax cost. So last night in the budget, the proposition announced would be that leaving employment would not trigger that taxing point. You could leave where you're working, you'd have the employee shares, you wouldn't necessarily be taxed at that point in time. You'd be taxed on the other trigger points, which is typically when the constraints on disposal of the shares or exercise of the rights, when those constraints fall away. So that was what was announced last night. In terms of the particular question about the tax thresholds, probably the thing to say is that in employee shares, there's essentially two basic pieces of relief. There's a $1,000 all employees in type piece of relief, and then the other piece of relief is what I said before, which is where you've got constraints on disposal, and then you have a deferral of the taxing point. There's not really any tax thresholds which work for those two systems. They're the basic systems. We're not moving away from those systems. We're just on what the government's announced is on the second system, the deferral system for where you've got constraints or where you leave employment. The leaving employment trigger for when you get taxed, that trigger is going to go away.
Looks like a lot of our questions are around budget leaks that came out. So were there any changes to annual amounts that can be submitted to super for those under 60?
Well, there's one big change, and Alan referred to it, which is that there is an incentive if you sell your house to make a $300,000 contribution to super. You can do that irrespective of what other contributions you've made. It used to be that would be up to age 65. The proposition is now to bring that back to age 60. So obviously to encourage a little bit of activity.
Yeah, it's a supply side thing. It's saying I want empty nesters to sell out. And therefore more houses will be available.
Stop hoarding land sort of thing.
Exactly. You've still got to be in your house for 10 years before it works, but so that was sort of what they're trying to do.
Which might make efficient use of housing occur, which might create a little bit of productivity.
Yeah, that's right. Might also put a little bit of downward pressure on house prices. Yeah. That's sort of what they're trying to do.
So another question is, were there any changes, and it's just popped off the screen, were there any changes to annual, so we looked at the super stuff, and what's the panel's view on the impact on house prices of this budget? Is government spending on infrastructure and other measures going to further boost house prices, in particular in regional cities?
I think, well, I'll start off by, did the budget do anything for house prices? I don't think they did a lot. By keeping the economy going, that's sort of good, but I think to some extent house prices are sort of catching up in compared to the momentum that's now there, and people are also looking to a situation where it's very unusual, but we're seeing it a lot, where if you buy a house or an apartment and take your mortgage, the cost of that mortgage is actually less than the cost of renting that same property. And so that's why you see a very big driver. It's not the investors, it's not the foreigners, it's the first homeowners. So was there anything specifically in there last night? No.
A little bit of super draw out for
yeah.
first homeowners increased.
Yeah.
To 50.
But do you think there'll be massive numbers of people drawing down their super? Like during,
Well, there
with
was
the COVID,
last year.
yeah.
Last year there was, and what was different last year is we were tracking it. Previous tax cuts, the average consumer would basically spend 20% of it and bank 80% of it, pay off their mortgage. Last year, in terms of those two super withdrawals that you were allowed, they spent about 80% of it. So it was almost like you took your money out and it was sort of a great bang, everyone gets it.
And spent it on housing?
No, they spent it on the shops.
Yeah.
So that was a contribution to keeping the economy going. But in housing, I think really we would expect that you would see about 15% increase in house prices this year, and then slowing down a bit. There is a sort of an issue in distribution. So in other words, people are now working from home, so they're buying at home. They're also, as long as you've got good internet, they're happy to live in, if I'm in Melbourne, I'm happy to live in Geelong or Bendigo, Ballarat. If I'm in Sydney, I'm happy to live in the Blue Mountains. If I'm in Brisbane, maybe I'm happy to live in Noosa, etc., etc.
I think all these measures in the budget are probably pretty small relative to the fundamental drivers of housing at the moment, which is that we're in an environment where, as Alan mentioned, the cost of borrowing is, at historically low levels. We have a central bank that's explicitly committing to keep rates low, and so for that reason, real assets, of which property is one part of that in your portfolio, I think are going to continue to do pretty well. And some of the sort of initiatives in the budget might sound worthy, but I'm not sure that they're going to make a whole lot of difference to the supply and demand dynamic in the short term, which is ultimately what drives up house prices.
And the implications of migration, how do you think that, if you sort of think that's one big missing link in terms of the whole of housing price pressures?
Well, the government specifically said last night in the budget that they weren't expecting international people coming back till next year,
correct,
2022.
Yeah.
And so that sort of does
Yep.
limit the amount of people.
Yeah.
Maybe that plays out more
Yep.
in the distinction between houses and apartments,
Yep.
where
Yeah.
houses have
opposed-
obviously outperformed
yeah.
apartments,
Yep.
not so much.
Very much.
Yeah,
so.
particularly in CBDs
Yep.
and anywhere close to education, universities,
Facilities.
etc. That's
Yep.
still a big issue.
Yep.
Okay, so Alan, another question for you. You mentioned cutting red tape for business, which we've been talking about forever. What specifically do you believe should be down immediately and then over the medium term?
Well, one of the things that we were very keen of during the pandemic was trying to say, right, if you want to get a project approved and it's going to take you 2 years, normal, let's just make it 12 months, generally. So try and, just as a general rule is, whatever the government approval time is, you commit to halve it. You can do that almost straight away. And I think that would be really important. And so that's the sort of thing I would be looking for. And then also, to the extent there's any differences across states in terms of the rules they apply, try and standardise it, make it easier for people to get forward. So that's the sort of thing that I was sort of hoping to see in it. I may be wrong, it may be part of the election package, right, which becomes much more political, and so that's where you could see things brought forward and you could see more incentives in that sort of area.
Paul, you'd be surprised to hear that there's another tax question. Tax is very popular today. So why didn't the government bring forward tax cuts for individuals or companies?
Well, for individuals, they've of course done a lot in the last couple of budgets, and so you've still got the stage 1, 2 and 3 coming through, and they did extend the Limito by another year, which, as Alan says, that when you get it at the top level, which is between sort of $90,000 and $100,000, it's $1,080 of relief, and it phases up and phases down. So that was done. In individuals, as I said before, you'll move to stage 3 soon, where eventually everybody except the people at the very highest level will be taxed at a maximum of 30%. So that's a pretty low rate, and that's not far away.
But they didn't bring that bit
No,
forward.
they didn't bring that forward. But
why do you
remember,
think?
in October, we brought a whole lot of stuff forward, and in fact, almost backdated stuff. So there was a lot done in October around personal taxes. So there wasn't much capacity to do much more right now. And then on company tax cuts, it's the same point. There's not much capacity because the headline corporate rate at 30% is very political, as we know, and there's now this international trend of possibly going back the other way. And at the same time, you've got this big elephant in the room, which is that the corporate tax collection is a mining tax. we know that for every $10 of iron ore price per annum, that's $1.3 billion of corporate tax collections. So, as Alan says, the budget is predicated on the price going back to 55, but it's basically at 225 today. If it sustains at 225, the government makes in corporate tax collections an enormous amount of money. And we also make money in coal, in metallurgical coal and thermal coal, and notwithstanding the green issues associated with that, the export markets there are also very profitable for us. So the corporate tax rate hypothecates is actually a mining tax. And if you look at our top 10 taxpayers, they contribute about 40% of our corporate tax collections. And in the top 10, once you take out the banks, everybody else is mining and everybody else is basically iron ore. And so reducing that corporate rate at the headline would have a significant impact on the way we're taxing what is right now a very, very profitable industry.
Can I also say I think there's a bit of politics in this? That basically, the opposition says they don't like phase 3. They know that I'm certain, will say they don't want to cut corporate tax rates.
Yep.
And so if you're going to pick a fight, pick your fight when the election comes around. In the meantime, just sort of get rid of things that might be difficult for you politically.
So another question is, why will inflation not be a problem over the next few years with so much government spending?
The reason that inflation will go up. Okay, so the first thing people should be aware of is when we get the next read for inflation, which is the June quarter, inflation will be well and truly above 3%. The reason it'll be above 3% is fundamentally because this time last year, childcare was free. Now it's no longer free. But you also do get some sort of ramp ups in certain sectors, like I was telling you about the bricks. And you also see it in agri as well. But what the Reserve Bank is looking at is what they call the trim.
Yep.
They trim the top 10% out, they trim the bottom 10, and then you basically take the average of the rest. To get that up, you need, in a fundamental sense, you need wages growth of 3.5. And so yes, there'll be hot spots. And, remember also, people talk about house prices. That's not part of the CPI. That's not a cost of living index. It's an actual price of buying certain things. So my sort of bottom line is there will be some big increases in prices, but fundamentally beyond that, if the economy is only growing at the rate we think it is, and if unemployment is sort of sitting where 4.5-ish, it's probably not enough to get you a 3.5% wage rise, generally. And so that's why we sort of say, and why the government, us, and the Reserve Bank all have the same view, that that's not enough.
Well, thank you so much all for your insights today. It sounds like this is a typical pre-election budget, big spending, but not much for productivity growth. So Michael, we'll finish off going over to you. Let's hear your final thoughts on behalf of NAB.
Oh, fantastic. Thank you. Thanks, Nassim. Firstly, I just wanted to say thank you to my fellow panellists and Alan for the in-depth presentation on the budget last night, and Sally and Paul for their insights that we've had through this conversation. I think when you look at what we've spoken about, but also look at what was handed down last night, my feeling is that we've got continued momentum in this economy for the next couple of years. The other thing that we didn't even talk about today was, we're in a very lucky position to have the economy moving forward the way it is, but also the health circumstance in check here in this country, which is something that I think sometimes we forget. So with the health thing in check and under control, and also the economy moving forward, I believe that there's going to be numerous opportunities for all of our customers that are connected on this line today. So for us, we just wanted to say thank you, and thank you to all our customers for letting us partner you whilst we've been through this past journey. In the last 12 months, I have to say, has probably been the most interesting time that I've had in 27 or 28 years of banking, and no doubt you on the line have experienced it as well. But we're grateful that you stuck with us, and we're looking forward to ensuring that the next 12 months we continue to partner together. So thanks very much for your attendance today.
Thanks, Michael. So to keep on top of what this budget means for your business, and so you know the way forward, make sure you check out NAB's federal budget coverage on its federal budget hub at nab.com.au/federal budget.